Hi, I'm John Kosar from Asbury Research in Chicago. Today's video will look at this very atypical stock market, one of the most unusual ones that I've seen after 40 years of being in the financial markets. We have weak internals, we have lousy market breadth, but we're making new all-time highs in the major US indexes. Doesn't happen very often. I can't remember the last time I saw it. Today in the video, I'm going to discuss what's happening underneath the hood of the market, why we think it's happening, and what to focus on so you don't get caught flat-footed in the next inevitable market correction that's coming. We don't know when, but I do think once it gets here, because of this atypical situation, let's call it an atypical setup, it could be bigger and more violent than investors are expecting. Let's begin by going to the Asbury 6. That's, I think, what a lot of investors know us for. And what the Asbury 6 is, we're going into the research center here, and we're scrolling down to the Asbury 6. And this is our daily indication of what the internal health of the market is. Watching the S&P 500 every day can make you dizzy, right? It's up 50 one day, it's down 70 the next. Really hard to not get caught up in the emotion of all of this tumult up and down. So we show 6 tactical metrics from the 30 or so that I like to use and I've kind of favored over my career. And we started to back test them. We found 6 that work really well together. They're all different. And we update them every day after the close. We look at the rate of change in the S&P 500. We look at the relative performance between stocks and high yield bonds. We look at investor asset flows, volatility, trading volume, and market breadth. When 4 or more of these through a monthly lens are green or positive, that tells us that no matter what's going on, the kind of crazy stuff happened in the S&P that day, the market is internally strong on a very tactical short-term basis. Right now, you could see 4 of these are negative. They've been negative as of June the 11th, and the market's up about 2% since then. And a lot of that is because of the unusual lack of market breadth, which I'm going to get into in just a second. But basically, outside of a handful of AI stocks, the overall market is internally weak and it's vulnerable to a very overdue corrective decline. The next thing we're going to do is look at one of these. We're going to look at trading volume. So we're moving over to our chart. And what we have here is NYSE. This is actually on Stockcharts. It's the NYSE Advanced Decline Issues Index. It's very close to what we use in-house here at Asbury, NYSE Cumulative Volume. And what you see is S&P 500 here up top of the 63-day moving average. Down here is what we're interested in is this volume. You can see really since the beginning of November of last year, with very few exceptions, it has stayed above the 21-day moving average. Why do we use a 21-day? It's a business month and it's Asbury Research's tactical time period. So you can see this has kept you in the trend. There's a little wiggle down here at the beginning of the year, which we're going to, a lot of stuff happened the second week of January, which we're going to get to. Here was the little correction that we had here during April. You can see cumulative volume dropped underneath and then it came back up again. But look what's happened since the end of May. We're drifting underneath the 21-day moving average. That means the market's going higher without that necessary volume that is important for us to maintain that volume. I think for short spurts, the market can get away with this, but overall, I've been looking at this indicator for a long time. Look at here between August and October of last year, when cumulative volume dropped off, that was a sell-off in the market. So this is a red flag for us. Now we're just going to go through some other metrics just to get a better sense again of what's kind of going on underneath the hood of the market. The next one we're going to look at is the relative performance of the S&P 500 versus bonds. That is right here. And we look at AGG. AGG is the iShares Core US Aggregate Bond ETF. So we're looking at its relative performance versus SPY. And what we see here is on November 6th of last year, which is really about a week after the bottom, we saw SPY outperforming AG, that is stocks outperforming bonds on a 63-day basis. Why do we just shift to 63 days? That's our strategic time period. When we're looking at a strategic metric, which this is for us, we look at 63 days, which is a business quarter. So you can see it's kept us in this trend. On April 19th and May 1st, we had a couple of retests of that trend. These are great places to buy back into this market in case you missed some of this. And this is full speed ahead right now. So stocks are outperforming bonds. That is one of the healthy aspects of the market as we see it right now. The next one we're going to look at is investor sentiment. And we're going to go to, it's called S&P 500 Large Cap Index here up top, which is the S&P. Of course, and down here is what I was looking for, AAPL bears, the percentage of bears. So what we've done here is I've just drawn in a horizontal line when we had the least amount of bears, which it's a contrary indicator. Under a normal market situation, when there's the least amount of bears with these individual investors from AAPL, we're usually near some kind of a near to intermediate term top. You see, we had one here in November of 21. We had another one here, April-ish of 22. Here's a little one, just a little blip here in early 2023. This was August of 2023. And then look what happened here. This is buried down at this 25-ish to 20% area, and the S&P doesn't care. It keeps going higher. This is telling you that the market is out of sync in terms of sentiment. And I think the reason that it is because we're in a very atypical market situation here where just a handful of AI stocks are dragging the market up by its hair. The next thing we want to look at is seasonality. So we're going over to Stockchart seasonality for the S&P 500. I set this to 20 years back. We actually look at one in-house that goes back to the late 50s, but I think right now maybe this is a little more germane to what's happening. So what we've got here is a pretty weak June. Our charts look at the, this is annually, there are 12 columns here for annual. In-house, we also look at it quarter per quarter. I could tell you the last 3 weeks of June, which we're in the midst of right now, are seasonally the 3 weakest weeks of the entire second quarter. And again, our data goes back to 57, but we see strength in July. It's one of the 3 strongest months of the year, going back 20 years now, using the stock charts. So that suggests, at least from a seasonality standpoint, if we can get by June, we could still see some strength next month. And then we get into this kind of lull here, August, September, October, excuse me, which are 3 of the weakest months of the year. The next thing that we want to look at is market breadth. I actually label this, we don't have any bears, right? It seems everyone is bullish. There's the least amount of bears that we looked at a slide back, but there's no breadth. So we have no bears, but no breadth. So let's go and look at the next chart right here. And we're going to look at, this is the percentage down here. This is the percentage of NYSE stocks trading above their 50-day moving average. In a normal market behavior, when you get this number up into the 75-80 area, which the red horizontal line shows, everybody's, there's a lot of breadth. There's a lot, most of the stocks in the NYSE are participating in the uptrend, and they're above their 50-day moving average. That's usually when you see a market top. You see, we had one here in August of 22, another one in Dece of 22, early in 2023, and so on, all the way through here. This was that big one that we had the beginning, end of August, beginning of July of last year. But look what happened here. We got right up here again. This was late December, first week of January. I was looking for a top. This was one of the indicators that said, be careful, the market's getting a little too frothy. On January the 8th, what happened here was we had a Las Vegas convention, an AI convention. It was called the Consumer Electronics Show in Las Vegas. NVIDIA announced something that they call Riva. It's a GPU accelerated software development kit, which I have no idea what that means, but it was for developing speech AI applications. That's when NVIDIA broke out. We're going to look at a chart of NVIDIA in just a few minutes. That overrode all of this. In other words, breadth started to deteriorate like it does when you're in a market top situation. This time it didn't do that. Why? Because the biggest names in terms of market cap were all affected by this AI. And it basically, 3 or 4 of them just kind of hooked the rest of the market up on their back and dragged them higher. Here you can see we had another one here in early to middle April. We had a little blip, but it didn't last very long. It lasted 2 weeks, and now we're off to the races again. NVIDIA, Apple, and Microsoft are really driving the bus here. So the next one that we're going to look at now is, let's look at support, right? So we know that there's just a handful of stocks that are dragging us higher, but the S&P 500 still matters, and we have to know where support is. So here's the S&P 500 going back to September of last year. Here's where we are right now. 5227 is the uptrend line from the origin of this most recent move higher, which was October 27th of last year. The 50-day moving average is here in blue. It's a pretty well-watched minor trend proxy. So 5227 to 5210 is where the tactical support is. It's actually 5% underneath the market as of right now. Again, 5227 to 5210. If we break there, that would indicate from a price standpoint that we're beginning a downside move. We're beginning some kind of a pullback. But as long as we stay up above that area, the trend's still intact. It's too early to make the assumption that the market's going to head lower. Major support is way down here, 12% below the market at 48.22 to 48.19. What does that mean? That means if we do break down through this support over the summer, we can drop down another significant amount, basically another 400 points, and still be in a major uptrend. The next 3 charts, I think, are the most important here right now, the ones to really pay attention to. We're going to look at NVIDIA. This is NVIDIA. This time I switched it up here. So I'm using a 63-day moving average, which is a quarter, and a 21-day moving average in red here, which is a month. And I'm calling primary tactical support is what we call it here, the place that has to hold for the minor trend to stay intact at 115.94 to 115.82. It's 14% underneath the market in NVIDIA. So that's really how far we'd have to move down in NVIDIA to indicate that there's a trend change coming on a tactical basis. We're nowhere near that right now. The next one we want to look at here is Microsoft, which is another one of that top 3 of those AI names. So here's Microsoft. On 6/11, June the 11th, we broke out of this investor indecision. Students of charting and technical analysis are going to call this a triangle, but we broke out of this triangle. It targets a move up to 473. 473 in Microsoft is another 6% up above the market. So if you were asking me, John, tactically, how much higher can the market go? Microsoft is one of the top 3 in market cap. It's saying about another 6% higher to 473. When would that be broken? What would have to happen to change that target, or to nullify that target? We'd have to come all the way back down to 418.50, which is a long way below the market. So last but not least, we're going to look at Apple. Apple is another one of those big ones. It also had a breakout on June the 11th, this time from a big rectangle pattern that started in July of 2023, almost a year ago. So we broke out of that at 6/11. Actually, on 6/10, right here, Apple had what they called a demo day, and it was a demo of Apple Intelligence, and it was also the announcement of the integration of ChatGPT, the AI, into their platform. That prompted this. We've got a target here of 230. and that's about 7% higher than the market is right now. So we got about 7% higher targets in Apple and also in NVIDIA that kind of dovetail with each other. So to sum everything up, the market is healthy by certain standards. Stocks are outperforming bonds. We've got good trends. We're making new all-time highs, but the market's extremely narrow. We've got some seasonality issues through the rest of this month, and then we've got seasonality issues again from August through October. Market breadth is dismal. So, and really nothing's outperforming. I think out of the 83 different ETFs that we track that cover commodities in industry groups and sectors, only 5 of those are outperforming the S&P 500 on a 63-day basis, which is one business quarter. Very narrow market. So instead of staring at too many indicators here, we're really focusing on that 3, Apple and Microsoft and NVIDIA. They are driving the bus here, and we need to pay special attention to them because this is a special market. So to sum it up, if you like our approach, we offer investment research for both individuals and money managers, and we also offer money management for both of those 2 groups. And if you'd like to contact us, here's how you do so. Thanks for listening. I hope this was useful to you and gives you a better understanding of what's going on under the hood of the market right now. And we will see you next time.